No company is going to be immune, including us. If you overinvest, we'll have to work through that phase. It's also true when we go through these investment cycles, there are moments we overshoot, right, collectively as an industry.
The massive investments they're making, we're talking about hundreds of billions of dollars of capital expenditures to build data centers, to hire engineers, to do these weird circular financial deals with startups like OpenAI and Anthropic. It's not clear if that's actually driving revenue to the tune of the amount of money that's going into it.
With the single biggest influence over the market right now, which is giving pause to the idea that the AI bubble is bursting. I'm talking about NVIDIA, the AI giant, right? They're driving that boom right now because of the powerful computer chips they make. The company beat expected earnings by more than $2 billion.
Everyone agrees the AI market is a bubble. Literally everyone. Analysts, investors, Reddit threads, your uncle at Thanksgiving. Bubble, 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 bubble. It's the only thing anyone can say about AI investments without getting laughed at. And the evidence seems pretty clear. The entire market is being carried by a few firms speculating about the future. They're playing, say a bigger number every quarter. The products they're releasing are nowhere close to covering costs. And every day, it looks like tech CEOs are just passing the same pile of money around to make their balance sheets look good. So here's the thing that should make you uncomfortable. If everybody knows this is a bubble, why are informed investors still piling billions into it every month? Are they dumber than us? Or do they see something we don't? The dot-com bubble popped because of 3 specific triggers. Microsoft got sued for antitrust violations. MicroStrategy revised their financial results and their stock fell 60% in a single day. The SEC got involved, and one article pointed out the unviable business model most companies were running on. A few years later, the housing bubble burst when subprime mortgages started resetting, and loan originators filed for bankruptcy. The AI industry has had way more things that could have popped it already. Market instability around tariffs, legislative controls over AI chips, rising interest rates, legal challenges over training data, infrastructure problems. Studies showing businesses aren't actually using this stuff, and what looks like increasingly desperate attempts to generate any kind of revenue. Not to mention, if one article in 2000 could unravel the dot-com bubble, surely the daily articles about AI problems should do the same. But so far, the market has basically shrugged all of this off. And it's been able to do this for 3 reasons nobody's talking about. First, where the money is actually coming from. Over the last decade and a half, big US tech companies built up an enormous pile of cash. Microsoft, Meta, Apple, Alphabet. They have more cash than any other companies on the planet outside of insurance and financial firms that are legally required to hold reserves. They've been saving for almost 2 decades. And there are 2 reasons why. Before 2017, tax laws heavily incentivized shifting cash into offshore accounts, primarily Ireland. The exact structures they used were complicated, but once the cash landed there, they couldn't touch it without paying tax on it. So they just slowly accumulated billions, waiting for something to use it on. In 2017, these companies got offered a one-time deal. Bring your offshore savings back to America for a small tax concession, which gave them massive dry powder to make big local investments. They used some for share buybacks, kept some abroad for international operations, but they also earmarked billions for future capital expenditures. The second reason they built huge cash reserves? For a while, these companies were struggling to find projects worth investing in. They'd become so dominant in their markets that spending on development was seen as unnecessary expense, not worth the risk. Today, that changed. The big companies driving most data center expenditure are almost making up for a lost decade, where they arguably weren't investing enough into new projects. This also applies to all the money they're introducing to support firms like OpenAI. Sure, the money gets passed around a lot once it's in the system, but the initial source is largely cash these companies had sitting on the sidelines. Compared to the housing bubble, which was propped up on debt and rigid derivatives, these companies are building on a solid fiscal foundation. Having a strong foundation doesn't guarantee the house you build on top is good. Just because these companies hold trillions doesn't mean setting it on fire to chase one bet is smart, but it does mean something different than the dot-com collapse. The second reason this might not be a bubble, the circular dealing everyone's mocking might actually be smart risk mitigation. NVIDIA investing into OpenAI looks suspicious, but if AOL had invested in Amazon back in 1999, we'd probably think that was genius. By investing up and down the supply chain, these companies are maximizing the chance they'll capture whatever value AI eventually generates. Here's the detail most people miss when they expose the financial circle jerk. These companies aren't taking investors' money. Netted out, the major players are paying out far more through dividends and stock buybacks than they're taking in through stock issuance or borrowing. During the dot-com bubble, hyped companies were dependent on continuous streams of investor money to keep the lights on. Businesses that made no profit often didn't even make revenue. OpenAI is in that position. If they don't keep bringing in new investors, they can't continue operating. But they're not raising money from regular investors. They're getting it from companies that have plenty of cash to invest. And here's where the absurdity gets interesting. Nothing big tech does with their money right now will be popular. If they make capital investments into data centers, people say they're blowing money on chips that'll be obsolete in 2 years. If they buy their own shares, they're driving up demand on overvalued stock. If they buy shares in other companies, they're circular dealing. They can't win. But that doesn't mean these companies and the wider economy are completely safe. Share prices are clearly elevated, expecting AI products will eventually bring in trillions. If that doesn't pan out, prices could be reconsidered very quickly. The major players aren't at immediate risk of collapse. They have far more cash than debt. They have functional parts of business to fall back on. Their biggest risk? If this goes badly, they'll have to explain to investors why they thought spending hundreds of billions on redundant data centers was better than just paying out that money to shareholders. Nobody can predict what the future of AI looks like. Even the CEOs admit that. But they're framing it like this. They're betting $500 billion on a dice roll. If it comes up 6, they make $10 trillion. It's a risky bet. That doesn't necessarily mean it's a bad bet. By the way, it takes the sting off knowing the government will probably comp them some chips if they just keep the game going. But we don't say that part out loud. Here's what makes this different from past bubbles. The dot-com companies had no revenue and needed constant investor infusions to survive. Housing bubble was built on debt that couldn't be repaid. This time, the money is real. The foundation is solid. The companies won't collapse if AI fails. They'll just be really embarrassed and a lot poorer. And regular investors who bought at peak valuations will get absolutely destroyed. But the companies themselves? They'll survive. Write off the losses. Move on to the next thing. That's not a bubble in the traditional sense. That's just a massively expensive failed experiment funded by companies rich enough to afford it. The question isn't whether this is a bubble. The question is whether you're one of the people who gets crushed when it deflates, or one of the people wealthy enough to walk away relatively unscathed. And if you're watching this, wondering which category you're in, you already know the answer.